Hello everyone, I'm Preethal and I'm going to explain the concept of cost of capital. So basically, when a company wants to start up a new project or start a new business or make some new investments, it needs capital. So how will the company fulfill this capital requirement? Company will raise the funds, company will raise capital. Okay, there are two sources where the company can raise capital. The first source is through debts and the second source is through equity. Okay, debts is nothing but borrowing the money, whereas equity is nothing but issuing the shares or stocks of the company. Okay, debts include loans, bonds, issuing debentures, or borrowing money from the lenders. Whereas equity is nothing but issuing shares to public or to private placements and issuing the preferred stocks of the company. So these people provide capital to the company, and in return, in case of debts, company will provide interest, and in case of equity, company will pay earnings in the form of dividends. Okay, so the cost of capital includes both the interest to be paid on debt as well as the returns which is expected by the investors. Okay, so let's see the meaning. Cost of capital. Okay, cost of capital is the minimum return that is expected by the providers of capital to earn on their investments to compensate for the risk involved. Okay, debt people have lended the money to the company and they've taken a risk of lending the money, whereas equity people have made investments in the company, and it is also a risk because they don't know how the company is gonna work. Okay, so always the return on the investments should be greater than the cost of the capital. Okay, so if a project or investment's return is greater than the cost of capital, then such an investment or a project is economically viable. Okay, therefore this cost of capital, no, it is taken as a benchmark for taking the capital budgeting decisions, whether we need to invest in this projects, whether we need to start this business or we should not. To to take the answer yes or no, the company, this is used as a benchmark. Cost of capital is used as a benchmark. Coming to the components of cost of capital. Okay, components of cost of capital, we have four components. Cost of debts we have cost of preference shares, cost of equity shares, and cost of retained earnings. Cost of debt is nothing but the cost of borrowing the money, and in return for this outstanding debts, the company will pay interest. Cost of preference shares is nothing but issuing the preferred stocks of the company, and in return, company will pay fixed dividend. So always this preference shareholders are in priority to the equity shareholders. Cost of equity is nothing but issuing the shares of the company's stocks. Okay, whereas in return they will be compensated for the risk they have taken, okay, in the form of dividends. Cost of retained earning is nothing but it is the portion of the company's profit that are retained or it is reinvested in the business rather than being distributed to the shareholders as a dividend. Okay, instead of distributing as a dividend, company has reinvested it in the business or retained in the business. It is an opportunity cost. Why it is an opportunity cost? Because if it is distributed to shareholders, and if shareholders would have invested it the same amount, reserve amount, somewhere else, then they would get a better returns over there. So it is an opportunity cost. Okay, so coming to the formulas, we have the first formula of cost of debts. So cost of debts are of two types. It may be redeemable and it may be irredeemable. Okay, what is irredeemable debts? Irredeemable debts are those which cannot be redeemed during the life of the company. Okay, it can be paid off only at the event of winding up of the company. So redeem is nothing but to repay it back, whereas redeemable debts are those which can be redeemed during the specified period. Okay, maturity period, it can be redeemed. So both this irredeemable as well as redeemable debt receive the interest. So the formula of irredeemable is KD is equal to interest into 1 minus tax divided by the net proceeds into 100. Okay, why are we deducting tax over here? Okay, why are we deducting tax? Since interest is debited to profit and loss account, okay, since interest is debited to profit and loss account, the profit will be reduced and ultimately the tax also will be reduced. Okay, so for example, if the income is 100 and if the interest is 20, the ultimate profit will be 80 rupees and tax should be paid on this 80 rupees. So here it is a tax saving, it's tax benefit to company rather than a cost. So it is not a cost to company, it's a tax saving, a tax benefit to company. Therefore we have to deduct the tax. Why are we multiplying to 100? Because the cost of capital is expressed in percentage, so we need to multiply it by 100. Whereas redeemable debts formula is interest into 1 minus tax plus the redeemable value minus the net proceeds divided by n whole divided by the redeemable value plus the net proceeds divided by 2. Okay, redeemable value is after the maturity period, what is the amount the company has to repay. Net proceeds is what is the amount that company is receiving right now while issuing the debts. Okay, so how will you calculate the net proceeds? Is that company may issue at a premium or discount, so we should include those things. Face value plus the premium, deduct the discount if you have given, and any brokerage we should deduct it, as well as the flotation cost should be deducted. Flotation cost is nothing but the cost of issuing the debts. Okay, so this is the formula. The next one we have is cost of preference shares. Cost of preference shares is also divided into two. We have irredeemable preference shares as well as redeemable preference shares. Okay, so irredeemable preference shares are those which cannot be bought back by the company, whereas redeemable preference shares are those which can be bought back by the company during the maturity period. Okay, it may be 5 years, 10 years as per the agreed terms. So KP is equal to irredeemable formula is KP is equal to preference dividend divided by the net proceeds into 100. For how much of the amount being received, what is the dividend which they are paying? The dividend which they are paying is nothing but the cost to the company. So here we are not deducting tax. We are not putting 1 minus tax. Why? Because preference dividend is appropriation of profit. It is not debited to profit and loss account. Therefore there is no tax savings. Therefore we are not deducting tax over here. Coming to redeemable formula, we have preference dividend plus redeemable value minus net proceeds divided by n whole divided by redeemable value plus net proceeds divided by 2. N is nothing but the number of years, the maturity period. Okay, the net proceeds, same thing. If it is at a premium, we should add it. Discount we should minus, any brokerage or flotation cost also should be deducted. Coming to next, that is the cost of equity. Okay, we have various approaches. The first approach is the dividend price approach. Dividend price approach is nothing but KE is equal to dividend, okay, current year's dividend divided by price, the base year's price, into 100. Next we have dividend price approach with growth, the Gordon's growth model. Okay, there are two types of company where the formula over here is the growth model, means a company is growing, respectively the dividend will also grow. So dividend current year's dividend divided by the base year price into 100 plus growth. So earning price approach is nothing but KE is equal to EPS of the current year's earnings divided by price of the base year into 100. Similarly, earning price approach with the growth means the company is growing and the earnings also is growing. So EPS, earning price of the current year divided by the base year price into 100 plus the growth. Okay. Next we have the capital asset pricing model. Capital asset pricing model is nothing but KE is equal to risk free plus beta into return on market minus the risk free. Okay, so RF is nothing but the risk free return, beta is B is nothing but the beta, and RM is nothing but the return on market, and RM minus RF is there, no, that is nothing but the risk premium. Okay, to understand this better, let's take one example over here. Example is let's take an example of Coal India, whether what is the minimum return the Coal India company must give to the equity shareholders. Okay, so the beta of Coal India, we have taken an example of 0.917, and the risk free, okay, that is the fixed deposit, the risk free where beta is 0, where there is no risk. Okay, you're 100% sure that the amount is gonna receive over there. Fixed deposit, I have taken an example, risk free 7%, and return on market, that is Nifty ka return is 12%, where beta is 1. Okay, therefore the formula KE is equal to risk free plus beta into return on market minus the risk free. So risk free is 7 plus beta is 0.917 into return on market is 12 and risk free is 7. So when we add this, we'll get 11.585%. So what does it mean? That Coal India company must what? The company, the preference shareholders or equity shareholders are expecting 11.585%. So this is the cost to the company, that this is the minimum return that the company must give. Okay, next we have realized yield approach. Okay, realized yield approach formula is dividend plus price of the current year minus the price of the base year whole divided by the base year. Okay, next we have the cost of retained earnings. Okay, cost of retained earnings is divided into two, whether such retained earning is taxable and non-taxable. Okay, as I told you, okay, retained earning is a portion of the company's profit. Okay, if the company has not retained such profit, and if they have distributed to shareholders, then shareholders would have invest such amount somewhere else. Okay, when they invest such amount somewhere else, if such what the investment the shareholders made somewhere else, whether if it is taxable, then you have to deduct the tax. If it is not taxable, then whatever is the cost of equity, that is only the retained earnings. So cost of retained earnings is KE into 1 minus tax if it was taxable in the hands of the shareholders. Okay, individual tax creditors. If it was non-taxable, then the cost is whatever is the cost of equity only is the cost of retained earnings. Okay, so these were the formulas of cost of capital. Now the company will not only raise funds through only by equity or only by debt or only by preference shares or only by some through borrowing money from lenders. Company will raise from through various sources which may include all these 4 or 3. So what we should calculate, what is the weighted average cost of capital. Okay, weighted average cost of capital of all these debts, equity, retained earnings, preference shares and all. So we have two methods of calculating the weighted average cost of capital. First one is the book value method. Okay, and the second one is the market value method. So what is the book value method? Under book value method, Okay, the weights used are derived from the book value of different sources of finance as per the books of accounts. As per the books of accounts, whatever is the book value, we should consider that amount. And retained earnings are to be included over here. Okay, are to be included in case of book value method. Whereas in case of market value method, what is it? It is the weights used are derived from the market value of the different sources of finance as per the prevailing market price. Matlab, what is the current market price? As per that you should calculate the weights. Okay, here the retained earning is to be ignored. Why the retained earning is to be ignored? Because we are calculating as per market value. Whatever is the market value as the cost of equity, it is included. The retained earning is already included in that. So separately we should not calculate it. We should ignore the retained earnings when we are calculating it as per the market value method. Okay, now what is the format of calculating the weighted average cost of capital? So we have 5 columns over here. The first column is source of finance. What are the sources of finance? Whether it is equity, whether it is preference shares, whether it is retained earnings, or whether it is debts. Next, second column is the values, the book value or the market value. And the next is the weights. Okay, next column is the weights. How to calculate the weights? When we solve the problem, I'll teach you. Next, the individual cost of capital. Okay, whatever we saw the formulas, right? All these formulas, whatever is the cost of capital, the rate which we get, that we have to write over here. And when you multiply this cost of capital into the weights, we'll get what is the weighted average cost of capital. Okay, we'll get what is WACC, that is nothing but weighted average cost of capital. Okay, so let's solve one problem in both market value as well as the book value. Okay, so the problem is like this. Determine the cost of capital of Best Luck Limited using the book value and market value weights from the following information. So they have given the source and they have given the book value as well as the market value. Sources are equity, retained earnings, preference shares, debentures, and the book value amount and market value amount also they have given. So additional information they have provided that equity shares are quoted at 130 per share. Quoted at 130 per share means it is a market price which is given, and the new issue price is 125 per share, will be fully subscribed, and the flotation cost is 5 per share. That means what they have given the issue price, that is nothing but the base price, and the flotation cost also they have given. So from the issue price we have to deduct the flotation cost. Okay, 125 minus 5 will get the price as 120. Dividend during the previous 5 years, a dividend have steadily increased from 10.60 to 14.19 per share. Dividend at the end of the current year is expected to be 15 per share. Okay, this is a dividend price approach with growth they have given. Okay, to find out the cost of equity. Okay, directly they have not given the growth percentage, but indirectly they have given over here. So 10.6 it has increased to 14.19, and from 14.19 the current year dividend is 15. That means there is a growth over here. So we should find out what is the growth percentage. Okay, so we should find out the growth percentage. So let's calculate it. So calculation of growth. Okay, so how will you calculate the growth? They have already given last year they have paid 14.19 as the growth, plus how much percentage will give you 15 as the current dividend. So we should find out. Okay, so I've taken the calculator. So 14.19, let's try with 4% first, plus 4% I'll get it as 14.75. okay, so it's not 15. 14.19, let's try with 5%. I'll get 14.89. So it is also not 15. I'll try with 6% now. 14.19 plus 6%, I'll get it as exactly 15.0. So 14.19 plus 6%, I'll get it as 15. Okay, so therefore growth is equal to what? Growth is equal to 6%. Okay, the growth is 6%. Okay, so next what they have given over here, they have told preference shares, 15% preference shares with a face value of 100 would realize 105 per share. Means the net proceeds, okay, when they issue the preference shares, the amount which company is receiving is 105. Means 5 rupees at a premium they have issuing it. Next, they have given debentures. The company proposes to issue 11-year 15% debentures. Okay, so 11-year debentures, 15% debentures. 11 years, 15%. Yield on debentures of similar maturity and risk classes 16% and flotation cost is 2%. Okay, so what they have given over here, they have given that there is 11%. So the debentures number of years is 11 years debentures. Okay, and 15% they are 15% debentures they are going to issue. And similarly the company is having a risk of 16% class debentures. That means the 16% class debentures, they have issued at 100 rupees. And what if they are issuing 15% debentures, what will be the issue price? So they have to issue at a discount price. It is 16% debenture they have already issued at 100 rupees. At par they have issued it. Now if the company wants to issue 15% debentures, then what will be the issue price? So they have to issue at a discounted price. So how will you calculate it? Okay, so the issue price is equal to 15 into 100 cross multiplication divided by 16. How much will you get? You'll get about 15 into 100 divided by 16, 93.75. 93.75. Okay, so this is the issue price. Therefore total net proceeds will be how much of the debentures? Net proceeds will be 93.75 minus the flotation cost of 2 rupees. So total you will get it as 91.75. Okay, so we'll get it as 91.75. So next, they have given corporate tax rate is 35%. Ignore the dividend tax. Okay, so let's solve the problem now. First, we should calculate cost of equity. And they've already given, what is the formula? K is equal to dividend upon P naught into 100. So already we have found, they have given the question dividend as 15 divided by price is what? The issue price minus the flotation cost into 100 plus the growth we found out just now 6%. So we'll get 18.5% as the cost of equity. Next, cost of preference shares. Cost of preference shares, KP is equal to PD upon net proceeds into 100. Okay, preference dividend, they've already given 15% preference shares in the question. So 15% into face value is 100, will get 15 as a preference dividend. Net proceeds, they've already given in the question. It would realize 105 into 100 will get preference dividend cost 14.29%. Means what? The cost or the minimum return the company must give to preference shares is 14.29%. Next, let's come to cost of debentures. Formula is KD is equal to interest into 1 minus tax plus redeemable value minus the net proceeds divided by the number of years, whole divided by redeemable value plus net proceeds divided by 2. So interest is 15% debentures. So 15 into face value is 100, will get 15 as interest. 1 minus tax, corporate tax they have given 35%. Redeemable value is at par, so 100 minus net proceeds, we just now calculated it. We got 93.75% and we deducted flotation cost of 2 rupees, so we'll get 91.75. Number of years they have given in the question 11 years debentures, and whole divided by 100 plus 91.75 divided by 2, and we'll get the answer when we solve 10.95%. Therefore the cost of debentures is 10.95%. Next we have cost of retained earnings. Cost of retained earning is nothing but the expectation of the shareholders. So KR is equal to KE, but here you should keep in mind you should not deduct the flotation cost while calculating the price. Okay, because flotation cost is a cost to company and it is not a cost to the shareholders, so we should not deduct flotation cost. So 15 is a dividend divided by 125. Here you should not deduct the flotation cost. When we calculated cost of equity, we deducted over there because it is a cost to company. This cost of retained earnings is nothing but the expectation of the shareholders, right? So we should not deduct it. We'll get the answer 18%. So now we have to calculate the weighted average cost of capital under book value as well as market value. Okay, so first column is source, equity, debenture, preference shares and retained earnings, and the second column is amount. Amount is already given in the question. The book value, whatever is given, we should write the same amount and get the total. Next, how to calculate the weight. Okay, so amount divided by the total of the amount into 100 will get the weight. So 1 crore 20 lakh divided by 1 crore 95 lakh into 100 when we do, we'll get 61.50. Similarly, 9 lakh divided by 1 crore 95 lakh into 100 will get 4.61. So similarly, preference shares will get 18.46 and retained earnings will get 15.39. So when you add all the weights, it must be equal to 100. Next, rate, just now we calculated over here the cost of preference shares, cost of equity, cost of debentures, all the rate just now we calculated. So same rate you should write it over here. When you multiply the weight into rate, we'll get what is weighted average cost of capital. So 61.54 into 18.5%. When you multiply, we'll get 11.38. So similarly, we should do for all the three. We'll get the total weighted average cost of capital as 17.3. Similarly, under book value method, we should calculate, but here no taking retained earnings. As I already told you, it is already included in equity because it is a market value. And in the question also, they have not given the amount for retained earnings. So equity and debentures amount, it's already given the question. Weight, how to calculate, I told 2 lakh. Okay, for equity it's 2 lakh, 2 crore divided by 2 crore 44 lakh 15,000 into 100. So the amount divided by total amount into 100 will get the weight, and total of the weight should be equal to 100. Okay, then rate is nothing but just now we calculated it, right? The same rate have to write it over here. Weight multiplied by rate will get weighted average cost of capital. So 81.92 into 18.5% will get 15.15. Similarly, we should do for debentures and preference shares. When you add all the weighted average cost of capital, we'll get 17.59. So hope you'll understood the sum. Thank you.